investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as you can see, we've been in a long upward leg here with the price moving significantly above this 200-day moving average, which is the red line. Now I want to explain to you why I am still waving the caution flag out there for investors. When you have a major moving average like this, basically identifying the long-term trend, and you see prices moving vertically away or diverging away from the moving average, either up and away or down and away below the moving average, there is cause for concern because it is like a mini bubble forming within a major bubble. When you have prices going vertically, we all know that vertical price action cannot be sustained for long periods of time. We generally have corrections, and that is why I'm still out there talking about risk management strategies. If you relax in a market like this and the market pulls back and corrects, you're talking about a 1,200 point move here. It doesn't look like much on the chart. That's a 1,200 point move just back to the 200 period moving average. Now with that, you could also see down below that the last two trading days of this week were significantly lower volume. So when you have green candles going up vertically and the volume is dropping dramatically, I mean today's volume was less than half of what it was on Wednesday, that tells us that the buyers are losing their buying power. And that's just with the diamonds. I think what's happened here is the headlines from the New York Times came out and basically reported that there are more jobs and higher wages. And again, the New York Times is stating U.S. recovery starts to hit home. But you have to be very, very careful here as you read these headlines. These might be new jobs created in the month of November, 321,000 jobs in November. But folks, you really have to pay attention to what the truth is and get your facts before you start just buying into what I would say hype in the economic news. If you look at the actual numbers put out by the Bureau of Labor Statistics, you're going to see something that's very shocking. And again, something that many people are not paying attention to because they're too busy reading the hype in the headlines. There is a major bubble forming, and the higher we go from this point, the bigger the bubble gets, and the significance of a correction or even a collapse of the market becomes that much more real. We have actual numbers here. The labor force has dropped to a 36-year low. Now, what does that mean? Unemployment numbers are not the real numbers. It's the number of people who are actually engaged in the labor force. You see, the benefits in unemployment are temporary. So once people fall off the unemployment rolls, they're still out of work, but they're now counted as a negative number in the overall labor force. And you can see that our numbers are showing less than 63% of the population is actually working or reporting their work. And that is a significant number of people out of work. We're talking numbers that bring us back to 1978. Now, here's the most troubling part of what this particular chart is showing us. There doesn't seem to be any relief in this downward trend. We could actually continue down here and drop to a level that maybe brings us back to 1964. There is no bounce. It does not look like there's recovering. And you have to understand, there are more people in our population than there were back in 1978, yet the percentages now are dramatically lower than what they were even 8 years ago. So look at the facts and put your money in a direction where you feel it's safe. I'm not telling you completely get out of the market. I'm just telling you, put stops in. Learn how to manage risk. Go out there and learn how to read charts. When we see a divergence away from moving averages, sell out of some of your positions, take profits. keep your stops tighter than you normally would otherwise and look at all of the markets. If you look at the Russell 2000, you're going to see a slightly different picture. The Russell 2000 is closer to the moving average. It's not as a dramatic divergence as we saw in the Dow, but we are up against resistance. Now, this is a key part for us to look at. The Russell 2000, if it breaks over resistance, there's still another resistance level up at the 1210 level. So the Russell 2000 at this point is going to continue to bump its head against resistance here, and the moving average, the 200 period moving average that is starting to go sideways. And that's a more broad-based index. We look at the spiders, it's ticker symbol SPY. Again, you'll see a very wide divergence from the 200 period moving average. Go back in history. Look at the other times where we've been this far away from the moving averages. What's followed after we've identified these wide separation here? Well, when the price moves this far away from a major moving average, such as the 200 period moving average, you generally see major corrections in the market. And those corrections are generally 50% of what the previous upward leg looked like. Let me show you what that is. These are called retracements. If we go out here and we measure this upward leg right here, and we take half of what that upward leg looks like, to dissect that in half right there, what does that mean? Well, we pulled back 50% of that previous move. Look at this one. From this low to this high, we pulled back more than 50%. Here's the 50% mark right here. We pulled back more than 50% in that retracement. Here, in this upward leg, we pulled back 150% of the previous upward leg, and we had not yet had any kind of a pullback that would be considered a correction since October 15th. So we're long overdue, hence the reason why I believe we'll pull back at least to the 200 period moving average, and that's why I leave that caution flag in place. If we look at the VIX, we could see that the volatility index still on historic lows right here. This is the projected upward leg that I have in place on my chart. I'm leaving that there. I still think that we could be bouncing soon, but I'm leaving this here as a timeline for when I think that VIX is going to start to move up. The Qs, this is the tech sector, QQQ. You'll see that this is my projected trend line, at least the short-term trend, with gaps still being identified down here in the market. So these charts have not changed. I'm leaving these in place. But again, folks, I don't want to sound like the sky is falling and no one's listening here, but I do believe that the bubble is getting bigger and bigger, and we who live through the bubbles understand that when they pop, you will not have time to put any stop losses in place, because by the time the pullback or the sell-off takes place, the damage is already done and you will not be able to recover from that. So we are getting into long positions. Don't get me wrong. The people who subscribe to the trade alerts are doing very well with their trades, because there are certain sectors that will even rally when the overall market's correct. We just have to pick and choose which ones those are, and we can't just say, okay, we're just going to take a long position in every market right now and relax with that. It's not a time to relax. It's a time to be very strategic and make sure you're very defensive with a good, solid risk management plan in place. So that's the weekly market report from the Market Guys. I'm AJ Monty. Thank you so much. Have a great rest of the weekend. Bye-bye.